There is a phenomenon in markets that professional traders watch for obsessively. It does not make headlines. It does not generate excitement on social media, but it often precedes the most significant price movements of the year. And it is happening in gold right now. Gold's weekly trading range just compressed by 72% over 3 consecutive weeks, from 886 points to 691 points to 245 points. That final week showed only 4.8% intra-week range. For a market that has been moving hundreds of dollars per week, that kind of compression is remarkable. And here is what history tells us about compressions of this magnitude. They do not last. Volatility is mean reverting. When it contracts this dramatically, it eventually expands. The question is not whether range expansion is coming, but when it comes and in which direction it resolves. So in this video, we are going to explore the mechanics of range compression, understand what the technical indicators are actually telling us, examine why silver is behaving differently from gold in ways that deserve attention, and build frameworks for thinking about how to navigate this kind of environment. Before we dive in, I want to know where you are watching from. Drop a comment right now with your city or country. I am always fascinated by the geographic distribution of this audience. Whether you're watching from Manila or Melbourne, Singapore or San Francisco, Tokyo or Toronto, let me know. And if you find value in how I break this stuff down, subscribe to the channel. It takes 1 second and it helps me know you want more of this kind of analysis. All right, let me start with the mechanics of range compression because understanding why it happens helps you understand what it means. Range compression occurs when market forces reach temporary equilibrium. The buyers and sellers who were driving price in one direction or another have exhausted their immediate impulse. The trend may still be intact, but the momentum behind it has diminished. The result is narrower and narrower price oscillations as the market essentially catches its breath. Think of it like a coiled spring. Energy is building, but it is not being released. The longer the compression persists, the more potential energy accumulates. And when that energy finally releases, the resulting move can be explosive. Now, I want to be clear about something because this is where a lot of analysis goes wrong. Range compression tells you that a significant move is likely coming. It does not tell you which direction that move will be. The compression itself is direction agnostic. It is a setup, not a signal. The direction of the eventual breakout depends on factors that are separate from the compression itself. Fundamental catalysts, technical support and resistance, market positioning, news flow. All of these determine whether the spring uncoils upward or downward. So when I tell you that gold's range has compressed 72%, I'm not telling you gold is about to rocket higher. And I'm not telling you gold is about to crash. I am telling you that the current period of calm is likely temporary, and that preparing for increased volatility is prudent regardless of your directional bias. Let me walk you through the mathematics, because the numbers themselves tell a story. 3 weeks ago, gold's weekly range was 886 points. That means the difference between the weekly high and the weekly low was $886 per ounce. That is substantial volatility. It reflects active participation, strong opinions, and significant capital flows pushing price in both directions. 2 weeks ago, that range contracted to 691 points. Still significant, but notably reduced. A 22% contraction from the prior week. Last week, the range collapsed to just 245 points. That is a 65% contraction from the week before, and a 72% contraction from 3 weeks ago. The intra-week percentage range was only 4.8%. To put this in context, gold is trading above $5,000 per ounce. A 245-point range on a $5,000 asset is less than 5% movement. For an asset that has been as volatile as gold has been recently, that kind of calm is unusual. The expected daily trading range calculation, which uses rolling 3-month volatility data to establish baseline expectations, shows that actual daily ranges are falling significantly below projected levels. This divergence between expected and actual volatility is precisely what creates the technical foundation for range expansion scenarios. Let me ask you something. Have you noticed the reduced volatility in gold over the past week? Has it affected your trading or your attention to the market? Drop your experience in the comments, because I think understanding how different participants experience these compression phases helps everyone calibrate their own approach. Now, let me talk about the technical indicators because they provide additional context for understanding what is happening beneath the surface of price. The 21-day regression trend for gold remains in positive territory, which is good news for bulls, but it is exhibiting progressive weakness. It is not as positive as it was a week ago or 2 weeks ago. The slope is flattening. This kind of progressive weakening does not necessarily mean reversal is imminent, but it does indicate that immediate buying support becomes critical to prevent trend rotation into negative territory. If buyers do not step in to support current levels, the weakening momentum could tip over into actual downtrend conditions. The technical term for this is trend exhaustion. After an extended move in one direction, the buying or selling pressure that drove that move gradually dissipates. The trend does not reverse immediately, it just loses steam, and if fresh buying does not emerge to reinvigorate the trend, gravity takes over. Gold's parabolic trend has been active for over 10 weeks now. That is an extended duration by historical standards. Extended trends eventually exhaust themselves. That is not a prediction. That is a statistical observation. The longer a parabolic move continues, the higher the probability that it is approaching its conclusion. The weekly parabolic price flip threshold sits at $4,563 per ounce. If gold were to close a week below that level, it would trigger a technical reversal signal that would cause systematic selling from trend-following systems. That is over $500 below current levels, so it is not imminent. But it is the level that defines when the current uptrend would be technically invalidated. Now let me shift to silver, because there is a divergence happening that deserves serious attention. While gold has been compressing in a relatively stable range, silver has been underperforming. Last week, gold posted a positive 1.5% gain, silver posted a negative 0.3% loss. That might not seem like a big deal, but in the context of precious metals markets, this kind of divergence is significant. Even more interesting is what silver is correlating with during this period. Copper experienced a 1.7% weekly decline. Silver's behavior is tracking closer to copper than to gold. Why does this matter? Silver has a dual identity. It is both a precious metal and an industrial metal. About 60% of annual silver demand comes from industrial applications. Electronics manufacturing, solar panel production, automotive components, these are industrial uses that depend on economic activity. When the precious metals narrative is dominant, silver tends to correlate with gold. When the industrial metal narrative is dominant, silver tends to correlate with copper and other base metals. The current divergence suggests that silver may be transitioning from precious metal behavioral patterns toward industrial metal correlation structures. Industrial demand fundamentals may be overriding precious metal investment demand in determining silver's directional bias. This is important information for anyone positioned in silver or considering silver exposure. If the industrial narrative dominates, silver could underperform gold significantly during the current cycle. If the precious metals narrative reasserts itself, the historical correlation should return. The technical indicators for silver are more concerning than for gold. The day-to-day trend consistency indicator for silver has already penetrated below the critical zero-axis threshold. Gold remains above this level. This creates a significant divergence between the two metals that suggests sector-specific forces are at play, rather than unified precious metals sector behavior. Let me talk about something that most analysis completely overlooks: margin requirements. Because what has happened in COMEX margin requirements over the past 3 years fundamentally changes how these markets function. 3 years ago, on February 14th, 2023, gold was trading at $1,864 per ounce. The COMEX margin requirement was $7,000 per contract. Each contract represents 100 ounces, so you needed $7,000 to control approximately $186,000 worth of gold. Today, gold is trading at $5,064 per ounce. That is a 172% price increase over 3 years. Significant appreciation. But here is what most people do not realize. The margin requirement is now $46,000 per contract. That is a 557% increase. The margin requirement has increased more than 3 times as fast as the price. Let that sink in. Gold went up 172%. Margin requirements went up 557%. Silver is even more dramatic. 3 years ago, silver was trading at $21.85. Margin was $8,000 per contract. Today, silver is at $77.27. That is a 254% price increase, but margin requirements are now $76,000 per contract. That is an 850% increase. Why does this matter for range compression? Higher margin requirements fundamentally alter market participation dynamics. Retail traders who could afford to trade gold or silver futures 3 years ago may no longer have sufficient capital to meet current requirements. This reduces speculative participation. Fewer participants means less price volatility. Less volatility contributes to range compression. The market structure has changed. The increase in margin requirements has effectively priced out a segment of market participants. What remains is a more institutional market with different behavior characteristics. This does not mean prices cannot move. It means the character of price movements may be different from what we saw when retail participation was higher. The compression we are seeing may be partially a structural phenomenon related to change market participation rather than purely a technical setup. Now let me address the Federal Reserve situation, because this is the primary macro driver influencing gold's volatility patterns and range compression dynamics. The January 2026 economic data presents challenges for anyone expecting dovish Federal Reserve policy. Non-farm payrolls came in at plus 130,000, the highest reading since May 2025. Hourly earnings accelerated to plus 0.4%, suggesting persistent wage-driven inflation pressures. But here is where the media coverage often misleads. There's a significant divergence between headline and core consumer price index readings that financial coverage frequently misrepresents. The general CPI declined from 0.3% to 0.2% in January. That is the number you will see in most headlines. Inflation cooling, the Fed can cut rates, good news for gold. But core CPI, which excludes volatile food and energy prices, and is the measure most relevant to Federal Reserve policy decisions, accelerated from 0.2% to 0.3%. That is the opposite direction. Core inflation is heating up, not cooling down. This distinction matters enormously because the Federal Reserve makes policy decisions based primarily on core inflation, not headline inflation. The fact that core CPI is accelerating suggests underlying price pressures that the Fed cannot ignore, regardless of what the headline number shows. For gold, a non-dovish Federal Reserve represents headwinds. Non-yielding assets like gold compete with interest-bearing alternatives. When the Fed maintains restrictive policy, the opportunity cost of holding gold increases. This creates fundamental pressure that can limit upside potential or contribute to corrections. The March 18, 2026 FOMC meeting represents the next critical catalyst for policy direction and precious metals reaction. That is, 22 trading days from the current analysis. Any shift in Fed communication between now and then could influence how gold's range compression resolves. Let me walk through the critical price levels because having a map of support and resistance helps you navigate potential breakout scenarios. On the upside, the all-time high cluster represents ultimate resistance. The intraday peak at $5,586 was established on January 29th. The closing high at $5,411 was set on January 28th. These levels represent the targets for any bullish breakout scenario. More immediate resistance sits at $5,084 per market profile analysis. Breaking above this level would be the first confirmation of upside resolution to the current compression. On the downside, multiple support levels become critical for trend continuation. The first major support sits at $5,044. This is the immediate level that bulls need to defend. Below that, 4,948 and 4,852 represent secondary support zones. The volume-weighted average price magnet is centered around 4,921. This level acts as a gravitational center for price. Sustained movement away from this magnet with expanding volume provides confirmation of directional resolution. The most critical technical level on the downside is the weekly parabolic flip threshold at 4,563. Penetration of this level on a closing basis would trigger a technical reversal signal that would cause systematic selling from trend-following systems. This is the line in the sand for the current bull trend. Below that, the 2026 yearly low at 4,319 represents another major support zone. And fair value calculations suggest even lower levels might be warranted based on fundamental valuations. Let me talk about fair value because this is where the analysis gets uncomfortable for bulls. Current pricing at $5,064 represents a 28.3%. Premium above calculated fair value of $3,947 based on dollar debasement calculations. That is a significant overvaluation if those calculations are accurate. The Bigos market value assessment shows a smaller divergence, with current pricing only 6.2% above the calculated value of $4,768. Different methodologies produce different results, but both calculations suggest that gold is trading at some premium to fundamental value. The degree of that premium depends on your valuation framework, but the direction is consistent. Gold is elevated relative to various measures of fair value. This does not mean gold cannot go higher. Markets can stay overvalued for extended periods. Momentum can override valuation. But it does create additional risk on the downside if catalysts emerge that cause markets to refocus on fundamental value. The combination of range compression, weakening momentum indicators, elevated valuations relative to fair value, and Federal Reserve policy headwinds creates a setup where both significant upside and significant downside remain possible outcomes. This is not a one-sided setup. It is an inflection point where the next major move could go either direction. Let me spend some time on the broader market context because precious metals do not exist in isolation. Current data indicates margin debt exceeding $1 trillion in equity markets, representing a 36% annual increase. That increase significantly outpaces the S&P 500's 16.4% gain during 2025. This divergence between leverage growth and underlying asset appreciation creates potential instability. The relationship between stock market capitalization and liquid money supply provides another concerning data point. Current S&P market capitalization of $60.9 trillion represents 2.7 times the liquid money supply. This is an elevated ratio that historically has been associated with increased correction risk. Why does this matter for gold? Precious metals often serve as portfolio hedges during periods of broader market instability. If equity markets experience stress related to elevated leverage and stretched valuations, gold could see increased safe haven demand. But there is a caveat. During acute market stress, forced liquidation can initially pressure all asset classes regardless of traditional correlations. If margin calls force portfolio liquidation, even safe haven assets can decline temporarily as investors raise cash indiscriminately. This creates a complex dynamic where gold could benefit from growing instability concerns while also being vulnerable to short-term pressure during any acute deleveraging event. The range compression we are observing may be gold positioning for one of these scenarios, but which one remains unclear. Let me talk about strategic approaches during compressed volatility because this environment requires different techniques than trending markets. When volatility is compressed, the natural tendency is to assume nothing important is happening and reduce attention to the market. This is often a mistake. Compression phases frequently precede the most significant moves. Reduced attention during compression means missing the early stages of range expansion. Range-bound trading techniques become relevant during compression phases. Instead of trend-following approaches, traders may focus on support and resistance level identification with precise entry and exit execution. The compressed volatility environment allows for tighter stop-loss placement because the normal daily ranges are smaller. But here is the key insight. You need to be prepared for the transition from compression to expansion. That transition can happen suddenly. One day the market is quiet. The next day it moves 3%. If you're not positioned for that transition, you miss the move. Volume analysis becomes particularly important during compression phases. Low volume compression suggests genuine equilibrium. High volume compression suggests active accumulation or distribution that is not yet resolved into price movement. The character of the volume during compression provides clues about the nature of the eventual breakout. False breakouts are common during compression phases. Price may briefly exceed a resistance level or break a support level only to reverse and return to the range. Professional traders often wait for confirmation before committing capital, using volume expansion and momentum confirmation to validate that a breakout is genuine rather than a fakeout. The transition from compressed volatility to expansion presents unique risk management challenges. Position sizing must account for potential volatility increases. A position that seemed appropriate during a 245-point weekly range may be oversized for an 800-point weekly range. Capital preservation. During the uncertain transition period takes priority over aggressive positioning. Now let me address a question that comes up frequently during these compression phases. Should you trade the range or wait for the breakout? There is no universally correct answer. It depends on your edge, your time horizon, and your risk tolerance. Trading the range means buying near support and selling near resistance, capturing the oscillation within the compressed range. This can be profitable if you can identify reliable support and resistance zones and execute with precision. But the risk is that you are positioned counter-trend at the moment the breakout occurs. Waiting for the breakout means accepting that you will miss some of the move in exchange for higher probability confirmation. You will not buy the exact bottom or sell the exact top, but you will have greater confidence that the move is genuine rather than a false signal. Some traders attempt a hybrid approach, taking small positions within the range while reserving capital for larger positions once breakout confirmation occurs. This provides some exposure to the compression phase while maintaining flexibility for range expansion. The key is to match your approach to your capabilities and circumstances. Do not trade the range if you lack the precision and discipline required. Do not wait for breakout confirmation if your time horizon is long enough that catching the exact start of the move is irrelevant. Now, let me synthesize everything we have discussed into a coherent framework for thinking about gold's current situation. Gold is trading above $5,000 per ounce after an extended bull run. The weekly range has compressed by 72% over 3 consecutive weeks. Technical momentum indicators show progressive weakness while remaining in positive territory. Silver is diverging from gold and correlating more with industrial metals. Margin requirements have increased dramatically, altering market participation dynamics. Federal Reserve policy remains a headwind based on core inflation acceleration. Valuation measures suggest gold is trading at a premium to fair value, and broader market leverage creates potential for both safe haven demand and liquidation pressure. This is a complex setup with multiple conflicting factors. It is not a simple buy signal or sell signal. It is an inflection point where preparation for multiple scenarios takes priority over directional conviction. If gold resolves the compression to the upside, The targets are the 5,084 resistance, followed by the all-time highs above 5,400. The trigger for bullish confirmation would be a weekly close decisively above resistance with expanding volume. If gold resolves the compression to the downside, the supports are 4,948, 4,852, and ultimately the parabolic flip level at 4,563. The trigger for bearish confirmation would be breakdown below support with volume expansion and momentum deterioration. The honest answer is that I do not know which scenario will unfold. Neither does anyone else. What we can do is understand the setup, identify the levels that matter, and prepare our response for either outcome. Let me leave you with some questions to consider as you think about your own positioning. What is your time horizon for precious metals exposure? The compressed volatility may be irrelevant if you are investing for decades. It may be crucial if you are trading for weeks. How would you respond to a breakout in either direction? Having that answer before the breakout occurs prevents emotional decision-making during the volatility expansion. Is your position size appropriate for increased volatility? The calm of compression phases can lull traders into larger positions than they should hold during expansion phases. Are you monitoring the critical levels we discussed? Knowing where support and resistance sit helps you evaluate the significance of price movements as they occur. Drop your answers in the comments. I'm genuinely curious how different viewers are approaching this setup. Before I let you go, let me summarize the key takeaways. Gold's weekly range has compressed 72% over 3 weeks. This compression historically precedes significant directional moves. The direction of the eventual breakout is not predetermined by the compression itself. Technical indicators show weakening momentum while remaining in positive territory. The trend is not yet broken, but it is losing steam. Silver is diverging from gold and correlating with industrial metals, suggesting different forces are driving the two markets. Margin requirements have increased dramatically relative to price gains, altering market participation and potentially contributing to compression dynamics. Federal Reserve policy remains a headwind based on core CPI acceleration that contradicts the headline inflation narrative. Critical levels to watch are 5,084 resistance, 4,948 support, and the parabolic flip at 4,563. This is an inflection point requiring preparation for multiple scenarios rather than confident directional predictions. Remember, everything you heard here is for education and entertainment. I'm not your financial advisor. I do not know your situation. Use this as a framework for thinking, not as instructions for trading. Make your own decisions and own the results. Gold is compressing. The spring is coiling. The eventual release will likely be significant. The direction remains to be determined. Thank you for watching. I will see you in the next one.